everyone, and thank you all for joining me for this rather unconventional talk for PyData conference, Quantamental Investing. My name is Fabian Krause, and I run the quant technology team at Man GLG, and the purpose of this team is essentially to bring quantamental approaches to life, build systems around quantamental, and help our portfolio managers make better decisions. Who of you knows the term quantamental? Who has heard of it? And who of those actually know what it means? Cool. So most of you will learn something very new today. Spoiler alert, there will be no Python code in this presentation. I'm sorry about that. But I'll share what kind of systems we're building around the idea of quantamental investing, what kind of lessons we've learned in the last couple of years, and also how Python helps us to bring these to life. So Man GLG is part of Man Group, and we are operating worldwide. We have a large institutional client base, mainly sovereign wealth funds, endowments, pension funds. We manage around $112 billion, and we are split roughly in 5 business units. We've got AHL and Numeric on the quantitative side. We've got Man GLG, the part of the business that I now work in as our discretionary manager. We also have a private markets business and in GPM and a multi-manager in FRM. The main takeaway here is that we're doing quite a lot of things at quite a large scale. Yeah, we have 25 to 30 years experience in both the systematic and the discretionary space. And Man Group is a very tech-driven company. We've basically consolidated all our front office technology under the new umbrella of Man Alpha Tech, all based on Python. So we are essentially in the perfect place to bring these quantamental approaches to life, to get this fusion going between discretionary and systematic trading. And don't worry, I've already used quite a lot of finance terms. I will make sure that we speak the same language in just a bit. So my rough goal for today is to give you an idea of what quantamental investing is. Why do we actually need it? We already have big businesses around systematic trading, around discretionary trading. What does it actually give us? What kind of problems does it solve? Then I will give you an overview of what kind of systems we've actually built to help our portfolio managers make better decisions, and also share the lessons learned in the last couple of years. But let's make sure that we all speak the same language. Quant or systematic trading is essentially computer-driven trading. Algorithms make the decisions. We have quant researchers who come up with a model as to how to use market data, transfer it in different ways, use stats, use machine learning to come up with a signal as to whether to buy or to sell certain instruments, build a portfolio around it, and then execute that in the market. The characteristic of such portfolios is generally that you have a large number of instruments or stocks when you trade cash equities. You almost have like an unlimited ability to process data, depending on what your cluster is capable of, depending on what kind of machines you have in your company. So the main selling point around systematic trading is you're following a model. You take the emotions out of the game, and you let the computers just do its thing on a daily basis. However, you can also only use quantifiable information. Anything that is not specified upfront in your model, you can't really incorporate into your trading process, so you're limited to that regard. On the other hand, discretionary trading, and that's also where the space that Man GLG operates in, is driven by humans. Humans analyze companies, they meet with the company boards, they look at broker reports, they look at news events, they incorporate all kinds of information about a certain company in their trading process and make up their mind as to whether to sell or to buy certain companies. These portfolios are obviously quite concentrated because we humans, we're quite limited in our ability to process data, so we can only look at so many companies or so many instruments. But we are also able, or discretionary portfolio managers are able to use non-quantifiable information. Anything that comes up around a company, around an instrument, anything that is not even related to these companies but might have some macro effects can be incorporated in your trading process. And quantamental is really the blend of these two approaches. You take quantitative techniques, you take fundamental investing, you mix in some data. If you're really fancy nowadays, you call it alternative data, so credit card data or satellite images to track the number of cars in front of shops to come up with an idea of whether they're doing well or not. And voila, you get your new buzzword of the discretionary community, quantamental. But to make all of this a little bit more tangible for you, let's look at the trading process. And the way I see the trading process, I roughly divide it in 5 stages. Obviously, there are different ways on how you can do it. But in my mind, you start with the universe screening stage. You need to narrow down the amount of instruments that you could trade to the amount that you actually want to do research on or want to run your models on. In a discretionary environment, obviously, a portfolio manager can't meet with all companies worldwide. They need to narrow that down. Systematic signals or systematic strategies want to usually look at the most liquid names, so they throw out less liquid instruments so that they can quickly trade in and out of positions. And then once you have your universe, you start doing fundamental research on that universe. You meet with the company boards, you read broker research, and you make up your mind as to whether you like a certain instrument or you don't like it. In a systematic environment, that might just be a number crunching exercise. You take market data in, run your model, and come up with a signal as to whether to buy or to sell certain instruments. Once you have these instruments and you have your indication as to whether you like them or not, you build a portfolio around them, you run a portfolio optimizer, and you execute that in the market. In the last step, you look at how your portfolio is doing, right? You want to monitor whether you're actually making money, whether you're losing money, whether your original ideas pan out. In a systematic world, you also want to see whether the simulation that you came up with or that your researcher came up with in a Python environment actually reflects your live trading P&L. And the way we see Quantamental is essentially enrichment of the traditional discretionary manager's trading process by technology. Each of these 5 stages will be enriched by technology, will be enriched by quant techniques, and we'll try to make them better at what they do. So we see the Quantamental as an enrichment of a fundamental research process. Use new data sets, combine them in different ways, use quant analyses to answer very complex questions that you can't do just with Excel spreadsheets, and I'll give you a couple of examples of what we've done in the past later on. Also, you can use quant signals in your universe screening stage. We've built sentiment indicators using NLP on earnings call transcripts to give our portfolio managers an idea of whether it was a positive, or a negative earnings call. Also, you can use breakout signals. We also think about Quantamental in terms of all the tools that deal with behavioral biases, and I'll go into behavioral biases in a few moments. Lastly, even though it's not quite Quantamental, but we also use it under the same umbrella as essentially generating efficiencies for our portfolio managers. We want to make sure that in the trading process that you just saw, the portfolio managers, we automate the stages that can easily be automated by computers, where they're basically wasting their time. For example, copying data from one spreadsheet to another, right? You don't need a human to do that. There are lots of systems that can do that, so that they can really focus on their value add, focus on their fundamental research process, look at more company, do more in-depth analyses, and become better investors as a whole. But I've already told you that we have large businesses around the systematic side, the discretionary side. They're huge industries built around both approaches. Why do we actually need anything Quantamental? What does it give us on top? And as Python enthusiasts and computer scientists, you probably think, well, I can just build a computer model that does everything for me, right? Well, the problem is, when you work in complex domains, you can't really come up with a proper mathematical model to model reality perfectly. Yeah? They're always changing underlying assumptions. Your market conditions might change. How do you put a Brexit into your model? Yeah? And for fans of Nassim Taleb's work on the black swan, a lot of the quant techniques are also based around the idea of normality of your data, and that might not be really the case in real life. And a couple of examples where we can't really build systematic strategies around certain ideas or investment ideas are, for example, merger arbitrage. Yeah? For making money out of different mergers of companies, you really need to understand the legal groundwork. Yeah? We weren't able to come up with computers that can actually do that job for us, so we have humans looking at that. And another really good example is index events. Yeah? For those of you who don't know, index providers, MSCI or FTSE, they basically define their base universes. So for example, the MSCI World contains the biggest companies in the world. Then you have ETFs who map these indices, who actually make them accessible for you as an individual to trade in them, to get exposure to them, to get the same returns that your index would get. These ETFs essentially need to rebalance every time the index comes up with a new list of stocks which should be in and out of the index. Yeah? So on a quarterly basis, they'd have these big rebalance events. And you would think that MSCI and FTSE, they provide me with a detailed rule book. I think the MSCI is around 800 pages long. So you can basically code that up step by step and come up with your prediction that on each day you know what should be in the index and what shouldn't. The problem is that these index providers also apply quite a lot of discretion in their process. So, for example, in May 2019, Argentina was moved from being a frontier market to becoming an emerging market. And that essentially, I mean, it doesn't really sound like a big deal. Emerging market, frontier market, what does that even mean? But it essentially means that your base universe of companies who should be in each of these buckets changes completely. Yeah? And you will get all your predictions wrong because if you, in these index events tradings, if you get one prediction wrong, you basically get them all wrong. Yeah? And so if you're trading index events, you really need a human analyst who keeps in touch with the index providers, who keeps in touch with the brokers, follows the news to anticipate these changes and make sure that your model is not completely going rogue. So should we just let humans make all of the decisions then? Go back to traditional trading. Well, you all know that we're quite limited in our ability to process data. We are very bad at statistical reasoning, and in order to become really good at something, we require a frequent feedback loop. That is not really given in financial markets because you will never encounter the same situation twice, right? Market conditions will always change. Even just like a small variable might be different next time you encounter similar conditions. And we underlie behavioral biases. I just want to spend a few minutes looking at behavioral biases and how they affect our decision making. Most of you will be familiar with Daniel Kahneman, his work on cognitive limitations, behavioral biases. He published his popular book, Thinking Fast and Slow, around how our decision-making is impaired by these biases. He essentially thinks of our human mind in terms of two systems. System one being the system that is responsible for fast decision-making, yeah? Our intuitive part of the brain. And then you got system two, which is the lazy, the reasoning part. So every time your system one can't handle a question, a new task, it will defer back to system two, and system two becomes active and thinks more deeply around it. And I won't go into all of these biases, but I just want to give you an overview of how some of them might affect decision-making in financial markets. So I'll give you an idea of what the anchoring effect is, an example of the framing, and then we go into overconfidence as well. So the anchoring bias essentially means that an initial piece of information that you see disproportionately affects how you see the world, even though you see lots of other counter arguments for it afterwards. So, for example, your favorite broker gives you a buy recommendation for Vodafone. Yeah? If you then see lots of other brokers saying, no, Vodafone is not really a good stock, you might still be biased toward this initial piece of information. And the way Kahneman and his colleagues test that and did the studies on that was essentially to give participants in two groups the same task, essentially create the product of the first 8 integers. Yeah? Both of these groups didn't have enough time to come up with the correct answer. They didn't have enough time to do the mental arithmetic, so they had to come up with an educated guess. The first group was tasked to multiply numbers in an ascending order, 1 times 2 times 3, etc. The second group in descending order, 8 times 7 times 6. And what they found was that group 1 significantly underestimated the true result. So when you start with a 1, multiplying 1 by 2 by 3, you significantly underestimate the true result. Similarly, on the group that overestimated the true result, so the group multiplying numbers in a descending order, they overestimated the result significantly. So you can see how that affects our decision making when we actually have to look at financial information, different pieces of information from our brokers, etc. An example of how the framing effect might affect our decision making would be to look at what a drug can do for you, right? You can either frame it as this drug cures the disease in 90% of the cases, or you could say that even though taking this drug, 10% of the trials or trialists die using this drug. And obviously, you've heard a lot about overconfidence already. Overconfidence in financial markets is also a problem if you think you're better than you actually are. And the traditional research on overconfidence was done by Russo on his work on decision traps. And what he's doing is essentially he gives participants a list of 10 questions, And for each of these 10 questions, participants are tasked to come up with confidence intervals. 90% confidence interval, give a lower bound, give an upper bound, so that you're 90% confidence that the true result will lie within those. And if you're a well-calibrated human being, you will get 9 out of these 10 questions right. If you're overconfident in your ability to answer these questions, you'll get much fewer right. So in his original work, he found that most participants only get 4 or fewer of these answers or these confidence intervals right, showing that there's great overconfidence in answering these questions. And we've replicated that actually at Man GLG last year, because we thought, well, maybe if you're an educated human being, you know a lot of stuff, you can actually calibrate your confidence bounds a lot better. And this is essentially the list of questions that we use. So we added some listed equity market cap of the world today, number of employees at Man Group. So things that you either know because you've read them, or you need to make an estimate. And we found the same results essentially. 80% of our 46 respondents only get 5 or fewer of these right. So even in our case, there's a lot of overconfidence at play. And that is also very in line with the academic literature on that. Barber and Odin did a study in 2013 investigating the behavior of individual investors, and what they found was clear sign of overconfidence and also clear signs of a disposition effect. So the tendency to sell winners and hold on to losers. And that's, for individual investors, that's not only a bad investment strategy in terms of your returns, but it's also really bad in terms of tax reasons. But you might now think, well, individual investors, we all have behavioral biases. Obviously, individual investors are not quite as experienced as professional investors. So do experts actually do better on this? Well, there's a study that recently came out, and I won't even try to pronounce the name because I'll just make a fool out of myself. But the researchers essentially investigated 783 long-only portfolio managers. Long-only meaning that you can't short sell any stocks. You basically always have to take a positive position in something. And what long-only portfolio managers generally do is they try to replicate a benchmark and then over or underweight stocks according to what kind of conviction they have around them. And these portfolio managers managed portfolios that were quite large. So on average, the portfolio size was $573 million. So you would think that if you're an expert, you don't run into these behavioral biases, and you actually find reasonable, make reasonable investment decisions. But they found that even though these portfolio managers had a clear skill in buying, their selling performance actually underperformed. And they compared what they've done on the selling side against a random strategy. So instead of selling the stock that the portfolio managers choose to sell, they actually chose another stock randomly from the portfolio and then compared the performance of these two strategies. And they found that the random strategy essentially outperformed on average by 80 bips to 1% on an annual basis, which is quite a lot considering the portfolio size. And so why is that the case, right? They found that these portfolio managers were very biased towards selling stocks that had extreme returns, so either on the positive side or on the negative side. You could come up with a proper economic rationale as to why they would do that. Yeah? If your stock has an extremely positive return, you might think, well, my original idea worked out. Let's make sure that we lock in some of the gains before it crashes down again. On the other hand, on the negative side, you might think, well, my idea didn't really work out. I probably did my research wrong. Let's get out of it, cut our losses. But what the authors also found by interviewing these portfolio managers was that they had a very limited attention span in the selling performance, right? They only saw selling as a means to raise funds to fund their next buys. And due to this limited attention span, what the authors essentially hypothesized was that it is because of the availability heuristic that they're actually choosing these stocks. Because stocks with extreme returns, they will be very prominent on the media, right? If you go on Bloomberg or Financial Times, if there is a stock that had a 20% return in the last 3 months, it's sure that it will be on there. And these portfolio managers, those will have exposure to these stocks and will have them in their mind. They come to their mind easily when they need to make a decision as to what to sell or what to buy. And another good argument as to why this availability heuristic might be at play here is that they also investigated what happens if it's not just the normal selling normal cell, but it's actually a cell around certain events. So if there's an earnings announcement coming out from a company, does selling around these events essentially show the same performance that the usual selling activity does? And they found that it doesn't. It's very much in line with their buying skills. So they're actually doing very well when they sell on actual announcement. It's only when they really sell to raise funds that they underperform random strategies. So this just shows you how behavioral biases might actually affect our decision-making in financial markets. So I've now told you what kind of problems you have with systematic trading and with discretionary trading, but obviously there are big industries built around that. I'm not saying these are completely invalid, right? I mean, they have their merits. The only thing I'm saying is that there might be something that we can do on top to mitigate some of these problems. And I'll show you a couple of systems that we've built around making our portfolio managers just a little bit better, removing some of these biases, and making sure that they can compete against computer systems and against their peers in the future. So what you need to know about portfolio managers and analysts that traditionally the use of technology was very limited. Yeah? You rock up at a shop, you get a Bloomberg terminal, you get an Excel spreadsheet, and off you go. For the last 25, 30 years, that worked well for them. So why would they change, right? What's there that they can't do in their traditional world? Well, first of all, it's like the amount of data nowadays is much bigger. Yeah? You need to compete with all the systematic strategies that use all kinds of data sources. You need to compete with your peers, which are already looking at data in different ways, might use more sophisticated technology. So Bloomberg and Excel doesn't cut it anymore. And we're actually bringing our Excel spreadsheets to their limits. We have a couple of plugins which do pricing, which do analytics, but even that is just not enough to process the amount of data that is out there. So what we are building, we're basically enriching these traditional systems with our Python platform. Yeah? We are building analytics tools, we're building backtesters, we give our analysts Jupyter notebooks, and build everything around our data on top of MongoDB and our Arctic open-sourced tick store. If our analysts are very tech-savvy, we also give them Unix environment, which they can use to actually schedule jobs on a daily basis, get more data in, and do even more complex analyses. One good example of how that has actually helped us to make our quants and our analysts better is last year in September. There was the FANG reclassification. So Facebook, Amazon, Netflix, Google, they were their sector was reclassified in the GICS, in the Global Industry Classification Standard, from IT to communication systems. Yeah? And that doesn't really sound like a big deal. Well, they're just moving from one sector to another. But one of our portfolio managers approached us and said, hey, what does that actually mean for my portfolio, right? Do I have any factor tilts that are not hedged afterwards? Can I do anything to exploit this process? And will I be completely under-hedged in some of these sectors afterwards? So, and these scenario analyses and getting all the data in place and then doing all the analysis on the risk side probably would have taken them our quants a week or more to actually perform. But using our Python analytics libraries and everything we have in Mongo, it basically took them an afternoon to come up with a strategy for our portfolio manager to do better and basically navigate this change. And talking about data, data is not really a competitive differentiator anymore. You won't be the only user of a certain data set. Yeah? So in financial markets, it's really important to combine data sets in smart ways, to ask the right questions, visualize your results effectively, and also get your interpretation right. So we found that Python is, and Pandas, NumPy is the perfect ground for letting our analysts do more sophisticated analyses so that they can actually extract value out of these data sets and not just get a new data set and use it as everyone else, because that just doesn't cut it anymore. But building this platform is not the only thing that we do. I always like to think about this as human-machine symbiosis. So we are building systems that work alongside our portfolio managers and make them better at their job. So one example of how we do that is in our center book. Our center book is essentially a book that runs internally, looks at our portfolio managers' positions, looks at who's doing great, who's not doing so great, who's doing great under what circumstances, runs signals on top of them, and then trades these positions systematically. So it's basically replicating internal portfolio managers' ideas, trading them in a more systematic fashion. The one metaphor that our portfolio manager of the center book always uses is using Lewis Hamilton as our portfolio manager. Yeah? Lewis Hamilton is a world-class driver, and what we in the quant tech team do is we try to build like a mini Hamilton, yeah? A robo Hamilton. We try to build a system that actually learns from Hamilton's experience, learns from his mistakes, and becomes better and better, and tries to outpace Hamilton in the long run. Once that mini Hamilton becomes good enough, Lewis might actually think, well, this guy is doing really great, and it's just replicating what I'm doing. So what am I doing wrong? So he's actually looking at that process and tries to find ways to improve his own driving. And bringing that to the financial world. So what we do is we not only look at the positions and the trading behavior of our portfolio managers, but whenever we find something where they have systematic biases or whether there's something that they can improve, we basically feed that back to them, give them reports, have sessions with them, just talking them through what we found and how they can actually improve their process. And obviously, finance is not the first industry that it's doing that. When you think back at chess, when Kasparov was beaten by Deep Blue, that wasn't the end of humans winning against machines. That was just the end of humans by themselves winning against the computer, right? There was a long era of hybrid teams of computers teamed up with humans, which were better than both humans by themselves and also computers by themselves. Lastly, I talked about behavioral biases. And what we try to do with our systems is essentially build systems that guide our investors to make the right decisions. On the left and right-hand side, you essentially see the famous Müller-Lyer illusion. On the left-hand side, you would think that the line in the middle for the top graphic is much longer than the one in the bottom. But once you put these decision boundaries in place, you'll actually see that your mind was just playing tricks on you, and they're actually the same length. So what we try to do with our systems is essentially take the emotions out of the game, take the current state of the mind out of the game of the portfolio manager, and really minimize the distance between the intuitive solution and the correct solution by designing systems in a smart way. And one example of where we do that is on the post-trade analytics side. Yeah. Here you can see a simple visualization of a stock price in blue and the position that our portfolio manager held in black. The green and the red triangles are essentially buy and sell decisions. And what that gives our portfolio managers is a way to analyze whether they went into a trade too late, whether they moved out of a trade too early, or whether they even moved out too late and therefore didn't really gain the performance that they could have gotten if they adjusted their behavior. Obviously, this is just like an individual instance, but if you think about that on a broader scale and basically analyze all trades of a portfolio manager, right? Run your Python scripts on top of that, use pandas for your analysis, and then come up with find out that this portfolio manager is always going out of positions too early, and he's basically missing out on like 1% every year just because he's trading out too early. Then we can feed that back to him and basically design our systems in a way so that next time he runs into one of these biases, we can guide them to make a better decision and then therefore perform better in the long run. So I've told you quite a lot about the systems or the kind of systems that we're building, but I also want to share a couple of the lessons learned in the last couple of years and how you could bring these quantamental approaches to life in your own firm, in your own asset manager. And these are really, I think broadly applicable. It's not only for quantamental approaches, but what we found is that you really need to work bottom up. Yeah, you can be really smart about your data science and come up with like a really smart system that you think will help them make better decisions and become better investors. But if they don't buy into that, they just won't use it and they won't even look at the data. They're already overwhelmed by what they have to look at on a daily basis, and they can't take anything they don't really want. Yeah, so you have to find champions in your company and try to identify real needs, yeah? Find solutions for these real needs, and then make these broadly available. And I think that's available in, or that's applicable to all kinds of domains. Yeah? You have to work bottom up. But what you also need is top-down support, because discretionary investment managers, they're very focused on this mindset, using Bloomberg terminals, Excel spreadsheets, and we can do anything we want. Yeah. So if your management is not behind your idea of building these quantamental systems, then you're basically lost from the beginning. Also, design, and I must admit, I'm not the biggest fan of front-end design. I'm not the biggest designer. Yeah, you can give me the latest machine learning libraries. I'll be happy for the next couple of weekends, but I really dislike front-end work. However, it's crucial in the discretionary environment that you design systems in a way that they don't hinder the current workflow. Yeah? Portfolio managers already have desktops with 20 Bloomberg screens open. They have their broker reports. Outlook is a big part of their process. And you can't design anything that takes up too much screen real estate. You really need to build systems that work for them and that enhance their workflow. So in one way we do that is we use the OpenFin technology. And for those of you not familiar with what OpenFin does, they basically brand themselves as the operating system of finance. And you get like a Chromium browser and a message bus so that you can run your web apps natively, connect to your other applications, and basically create this integrated user experience that we want for our portfolio managers, where you don't have isolated systems, but you essentially have like one flow, right? You come up, you do your analytics, you come up with your trades, right? One system talks to another, you push in your alphas, and then you can execute it in the market immediately. Lastly, data, and the same lesson holds true for data as it did for building these systems. Yeah, you can't really push data top down. If you just come up with new data sets and give them to portfolio managers, they won't even look at it. Yeah, you really need to look at what kind of questions they have, then find data to answer these questions, visualize the results effectively, combine data sets in different ways, and then make that data more available, more broadly available if people have already bought into it. So summing all of that up that I've told you, essentially there's huge merit, obviously, in the traditional approaches, quant trading, discretionary trading. Yeah, but there are also a couple of shortfalls. And what we try to do with Quantamental is essentially enrich the discretionary portfolio managers' investment process, make them just a little bit better than they were, take some of these biases away. So we are building systems that minimize the possibility for these biases. We build them in a way so that they are designed to enrich and enhance their workflow, and hopefully in the long run make them better decision makers in financial markets. And obviously Python and all the libraries, I mean, you've seen a couple of the ones that we're using in Man Group and Man Alpha Tech, Pandas, NumPy, they are super useful for us, and everything in our front office is essentially built around Python and making these tools available to researchers and analysts alike. So before we go into Q&A, just really quick raising of attention to our open source hackathon 2019. On the 2nd of November, we're working alongside you on open source packages in our London offices. So if you're interested in contributing, giving something back to the community, sign up at man.com/hackathon 2019.